The housing market is always drawing a lot of emotion. Some people say that the housing market's going to crash. Some people say that the housing market's going to boom. Some people say that the housing market's going to get more unaffordable. Some people say that we're going to see the biggest opportunity in housing ever in the near future. But what you need to understand now isn't all the emotion in the housing market, but rather what affects home prices. And the real factor that affects home prices isn't just the Federal Reserve Bank. It isn't just inflation. It isn't just the economy. It's supply and demand. Just like any other asset class. See, your home isn't worth what you list it for. It's worth what somebody else is willing to pay. Because if you think your home is worth $400,000 because a very smart agent said that your home is worth $400,000, and then you get 44 offers and somebody's willing to pay you $475,000, are you going to say, you know what, agent, I trust your judgment. I'm just going to sell my home for $400,000? No, you're going to sell it for $475,000. You're going to sell it to the highest bidder. So your home is worth what somebody else is willing to pay. But that can also work on the opposite side where you think your home is worth $400,000, but the highest offer you're getting is $335,000. Now, is your home worth $400,000? Maybe if you're willing to wait it out and wait for somebody to make an offer higher. But if you're not getting any other offers and you sell it for $335,000, then your home's only worth $335,000. And this is where you have to understand what are the factors that influence the housing market. And that goes to supply and demand. But in order to actually understand this, you have to understand what factors influence demand and what factors influence supply. Because if you have more supply than demand, what that means is you have more sellers than buyers. That's going to push home prices lower. Because if you only have 5 buyers for the 500 homes that are for sale, now these sellers are going to have to compete against each other to get one of these buyers to buy one of their homes. How do the sellers compete against one another? Well, they compete by cutting the prices of their homes. That is called a buyer's market. That's what we saw after the 2008 crash in 2010, 2011, 2012, 2013. That was a buyer's market because you had all these foreclosures, you had all these sellers, but nobody really going out and buying homes, which meant if you were a buyer, you had all the negotiating room and the leverage. A seller's market is the opposite. It's when you have a lot of buyers, a lot of demand, and not that much supply. That's what we've been seeing in 2020, 2021, 2022, where we have a whole bunch of buyers who want to buy a home, but not that much inventory, not that many sellers. And so now the buyers are competing against each other. How do buyers compete against each other? All by willing to pay higher prices or by bidding against one another. So now when you have 500 buyers and only 5 homes available for sale, these 500 buyers have to bid against each other by upping their asking price in order to buy a home. This is why you have to understand which factors are going to influence demand and which factors are going to influence supply. And if we start with the demand side, the most obvious factor that influences demand is interest rates, mortgage rates. Because when you have lower mortgage rates, you have more buyers. When you have higher mortgage rates, you have less buyers. This is what the Federal Reserve Bank is using to try to cool inflation, because the Federal Reserve Bank wants home prices to not grow so aggressively. How are they doing that? By raising interest rates, which is pushing mortgage rates higher, which makes it less affordable to buy a home. And when homes become less affordable, less buyers are out in the market to go out and actually buy a home. And to demonstrate what I mean, think about this. If mortgage rates fell to 3% tomorrow, what would happen? Your mom, your dad, your cousin, your sister, everybody will be going out trying to buy another home. Why? Because mortgage rates fell and people want to capitalize on the lower mortgage rates to go out and buy a home, which means now you're going to have buyers flooding the market, and we still have a very low inventory of homes for sale, which means you're going to see the bidding wars come back into the market, pushing home prices higher. So mortgage rates play a big factor on demand, but also the economy plays a big factor in demand, because when you see an economic slowdown, that means you have less jobs. That means you have people getting laid off. That means you have people worried about their incomes. And when you have that type of economic slowdown, or people worried about an economic slowdown, the last thing people want to do is go out and get a home, because that's a big financial commitment. And if you're worried about getting laid off, you don't want to go out and make a new big purchase because you don't know what's going to happen to your income tomorrow. And that's where you have to understand the economy plays a factor in demand, number one, in sentiment, but number two, with also incomes, because if incomes are falling, or if people are getting laid off, or if people are losing their jobs, that's less demand out there to buy a home. Now, today, we're still in a very strong economy. Now, part of that has to do with all the money printing that we saw in 2020, 2021, and into 2022, but our economy still has a lot of jobs. And so that still has the ability for people to go out and purchase a home, which is where if that starts to flip in 2024 or 2025, that could also impact demand, where higher interest rates cool down demand, and a slower economy also cools down demand. And the third factor that generally influences demand is really just consumer interest. Because what happened during the pandemic was people went from living in cities to now all of a sudden working from home. And today, yeah, people are going back into the office, but we still have a lot of people that are working from home or working a hybrid environment, which meant a lot of people wanted to get a new home with an office, or they wanted to upgrade their home because people are spending more and more time at home. And so because of that, the consumer interest started to change, and people wanted to upgrade a home. They wanted a home with an office, or they wanted a home with additional bedrooms. That way they could spend more time at home. And that change in consumer interest also boosted up demand, because now all of a sudden people wanted to own, and people wanted to own something where they could also work from. So the three main factors that will influence demand are mortgage rates, it's the economy, and consumer demand. Then you have to look at the supply side. What factors influence supply? Well, the first factor that influences supply is really just what are forced sales. A forced sale is something like a foreclosure. Because if you're seeing foreclosures happen, you're going to see an increase in the supply of homes out there. But up until now, we've covered this in market briefs, there really hasn't been that many foreclosures. I know some people talk about how foreclosures have been rising, but in reality, generally, there has been no real need for foreclosures in the last few years because home prices have gone up. So if you lost your job, you lost your income, you no longer have the ability to make the payments on your home, and you're way in over your head on your home, well, it doesn't make sense for you to go into foreclosure, because a lot of people, most Americans, have some sort of positive equity or even zero equity in their homes, which means you can sell your home, walk away, and maybe put some cash in your pocket, which means it doesn't really make sense for you to go into foreclosure. That's where the first part that you want to pay attention to on the supply side is forced sales. We're not seeing any of this forced sales. If home prices start to go down more drastically and more people became underwater on their homes, then if you see a slowing economy, that would also impact supply, because now if people become underwater and they lose their jobs, now people can't just walk away and put cash in their pocket. So that's the first factor you want to pay attention to on supply. The second factor that influences supply is home building. Now, we've been covering this in market briefs. If you have not joined market briefs yet, I highly recommend you do so, because market briefs is my free financial newsletter that I created that will keep you up to date on what's happening in things like the housing market, the economy, the stock market, the crypto market, and the global economy into a fun, witty, and easy to read email. You can read the email in less than 5 minutes every morning, and it's completely free. And if you read it, you're not going to be blindsided by what's happening in the economy and the housing market. So if you want to join market briefs, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. But when a home builder or a home developer wants to go out and buy a home, what they want to see is, am I going to make any money by me going out and investing millions of dollars to build this neighborhood, to build this apartment complex, to build this development? And if they project growth in the economy, they project growth in home prices, they're going to be much more likely to go out and build a home, because building a home takes months, sometimes even years, depending on how big the property is. And now you have to play through the scenario. If I'm going to invest, let's just say $10 million to build this neighborhood of homes, I want to make sure that I can make at least $12 million from sales of this property. That way I can actually make some money as a developer, as a builder. And that's going to compensate for my risk, for my time, for my investment, and for everything in between. Now, when I go out and I start projecting this, I'm going to look at what are home prices today. Okay, I'll be able to sell these homes for $450,000 today. Do I think I'm going to be able to sell these homes for $460,000 next year when they're completed? Or are they going to sell for less than $450,000? And this is where now home builders and developers are saying, oh, we're seeing downward pressure on the housing market. We're seeing downward pressure on home prices. We're not seeing the same growth in home prices, which is less incentive for me to go out and build a home, because that's a lot of risk. I don't want to go out and take on all these loans, take on all this risk, and spend all this time trying to build this neighborhood as charity. I want to make some money off of it. And if I end up losing money, that's going to be very bad. So supply meaning building, depends a lot on consumer sentiment, because if home builders believe that they're going to be able to sell their homes for big profits, they're going to want to build more and capitalize on those profits. If they don't think they're going to be able to sell them for big profits, they're going to be much less likely to build homes. And then sometimes you have the X factor, the government factor, which can influence this home building sentiment, because sometimes you can see the government come out and say that they're going to create incentives or subsidies for builders to go out and invest in neighborhoods, to go out and build homes. But beyond that, the factor that influences how many homes get created is really ultimately up to what is the sentiment in the economy, and do builders feel confident to actually go out and continue building homes. And then the last factor that influences supply is people's interest in selling. If people are going to make a big profit from selling their homes, they're going to want to sell, although they're still going to need another place to go out and live. But if people are going to lose money on their home by selling, they're not going to want to sell. So the three factors that influence supply are: number one, are people going to make money when they sell? Number two, what is home builder sentiment? And number three, are we seeing forced sales, things like foreclosures, which impact the amount of supply that we have? So now what you want to do, if you want to understand the housing market, you want to get a gauge for where the economy is going, for where the housing market's going. You want to compare the factors that influence supply and measure them against the factors that influence demand, and then see, when is demand and supply going to level off? Because today, we have demand here and supply here. We still have higher demand than supply. A couple of years ago, we had demand way up here and supply down here, which meant you had all these bidding wars because you had way more buyers than sellers. Now demand has come down, but is still higher than supply. But when will these factors even up? And are we going to see things where supply goes higher than demand? If supply starts to go higher than demand, that can pull home prices lower. If demand stays a lot higher than supply, that will continue to push home prices higher. But it's not just interest rates, it's not just the economy, it's all these factors on the demand and supply side together, which is why you want to make a holistic picture of the economy and the housing market and play it into one another. That way you can get a better idea of where home prices are going. CNBC put out a really good article titled "Financial Experts Share Their Greatest Money Regrets, and they all have one thing in common." And I think this article really explains very well the money regrets that people have in their 30s. So I want to go over the 5 money regrets that CNBC talks about here, because, well, I think these are really powerful ones. Let me start with